Inflation is one of the primary concerns when it comes to adjusted workers' comp rates in the near future. However, there are a few more factors that you'll want to be mindful of for upcoming rate changes. Let's discuss some of those here. At this point in time, you've probably heard about the effects of inflation ad nauseum when it comes to the prices of consumer goods. The average increase in expenses for consumer goods has reached a 40-year high when reviewed over the last year. Now, while this metric is pertinent to many individuals and specific industries, when it comes to workers' compensation costs, narrowing our scope to medical inflation is actually a more apt way of figuring out what the effects will be for rising costs when it comes to those workers' comp rates. Now, when we speak about medical inflation, we're focusing on things that are deemed healthcare necessities. That means treatments, supplies, pharmaceuticals, medical devices. These rising prices for those goods and services are what will actually drive workers' compensation rates. Now, projections for these healthcare necessities and the costs of them are made typically in a year in advance by institutions like Medicare or other private insurance contracts. The projections for current medical inflation were made prior to the recent surge of general inflation, which means that those costs haven't actually been baked into futures workers' compensation rates. Now, while that might result in some higher rates down the line, the good news is that historically, workers' comp has performed very well year over year when maintaining consistent pricing as compared to other insurance policies such as your commercial property or your business auto. The resiliency of those workers' comp rates bodes well for even an uptick in projected costs for necessary healthcare expenses. Some other factors, however, that might not be on our customers' forefront or the general consumer's forefront are also being considered for any variability in future workers' comp rates. One of those items happens to be just general labor shifts. And that speaks towards, within the last 2 years, people changing jobs at a bit more of a frequent pace for a multitude of reasons. But the main takeaway from that trend is that studies show that short tenured employees are more likely to be at risk and open up claims for injuries and illnesses at the workplace rather than their longer tenured counterparts. That's just historically a fact, and it probably has something to do with just the longer tenured people being more experienced and knowing a bit more about the safety and guidelines for day in and day out operations at their place of work. Compound that with an older age group of individuals in the workforce, meaning that about a quarter of the workforce by 2024 will be occupied by people 55 years or older. Those people, just at that age bracket, are more likely, historically, to be injured or have larger claims for illnesses or other things of that matter, be out of work, where a workers' compensation policy would have to cover expenses for those individuals. Next, on top of that, there's also wage growth considerations that have been factored in an effort to keep employees from jumping ship from one job to another. Salaries have been increased and overall wages for employees over the last 2 years, which is great. However, business owners must know that the exposure for your rate for a workers' comp policy is primarily based off of the payroll for all of your employees. So with increased wages, you can expect increased prices for your overall policy throughout the year. Next is simply, and this comes back to one of the medical inflation components, just the advancements that we've made in healthcare technology compound the prices for treatments for different sorts of illnesses and injuries that employees sustain while on the job. These new advancements for medical technology are great for getting people back quicker, but in a lot of instances, they end up costing more. One of the final considerations for variability in your workers' comp pricing is just the rating adequacy that has taken place. And when we talk about rating adequacy or the challenges for rating adequacy, the COVID-19 pandemic over the last 2+ years has made people shift from where they work in a lot of instances, meaning that because people might not be in the office or at the shop or at whatever the primary business location is on a day in and day out basis, and maybe their hours have been shifted as well for more flexibility, there has been already a significant drop off for number of claims at the workplace simply because more employees are working remotely. This is great in the short term historical perspective because it has made rates fall a bit and just prices drop incrementally. However, the actuaries who do these reviews on historical evidence and leverage it to make predictions on future pricing for adequate workers' comp rates are still undecided on the persistency of this trend of lower claims because more people are working from remote locations. But those are some of the considerations: medical inflation, labor shifts, wage growth, the advancement in technology for healthcare, and then the rating adequacy challenges. So keep all these in mind when you're looking to renew your policy or have it reviewed. If you'd like to get some suggestions or things to keep in mind when moving forward with your next workers' comp policy, feel free to reach out to us. We'd be happy to help and review your current coverage. Our phone number here at Joy Insurance is 845-342-4888, and you can reach me via email, liam@joyinsurance.com. Look forward to hearing from you soon.